subscribe now and press the bell icon. Never miss an update.
We looked into interest expense last time. If you guys remember, there's no personal interest is not allowed. So if you're paying mortgage interest, that's fine. There is always a deduction for that. There's always some kind of relief that IRS will give, but not on personal interest. Right? So credit card interest and all, that's not allowed. Any medical expenses, and if you're paying a loan or paying interest back on that, that's also not allowed. Then we saw the investment interest that can be deducted against investment income only, right? Otherwise, I think they can be carried forward or something. Yeah, here it says the disallowed investment interest is carried forward indefinitely because these are all considered to be passive income. So again, the passive income limitation or passive loss limitation rules come up, and we have to see most of the time the rule is that passive losses get offset only against passive income. So passive expenses will also get offset against passive gains. Then we saw about what is qualified residence interest, and also the whole point of giving relief on interest, especially on mortgage interest, is that a proper middle class person or a lower middle class person should be able to afford their own housing. Like, so a person who is super rich already and they want to go for $5 million house, $10 million house and all, like there's no point giving deductions to them. Why? Because that is not what IRS intention is. They want to increase these kind of deductions so that it becomes affordable for the people whose incomes are not that high. So that's why there is a limit put up that only if the loan is below $750,000, you should be able to take deduction on that. So that is considered to be a mean price or an average price, and also that's something people are expected to pay, and that's reasonable. A home equity line of credit can be taken. So that means you are taking another line of credit, another loan on the existing home. So that is deductible. I mean, obviously, interest on that is deductible only if those proceedings or if that money is being used for the purpose of home, either for buying, making an extension, building something, or renovation, or substantially improving the residence. If that loan is being used for education, medical, vacation, something else, or paying off some other personal loans, that is not allowed. You cannot claim that as a mortgage interest. Okay, then we saw here what is like the income and all, how much of the expenses can be taken, and we saw that the investment expense can be taken against investment income. And mortgage interest is anyways deductible. But personal credit card interest is not going to be deductible. Okay. We talked about points also. Points is something, again, very, very, very commonly used in US, very much, typical about real estate industry. Their points is something like an advance interest paid out in order to secure the rate of interest. So something that we are paying out ahead of time to get some kind of assurance that your interest rates are going to stay the same way. Otherwise, those are volatile. Otherwise, usually they will change. So if you're paying 2%, 3%, that's pretty good. Next year, if the interest rate goes up to whatever 7-8%, it can become very, very expensive to pay the EMIs. And well, talking about the interest and all, can anyone explain me what happened with SVB Bank? Did anyone did any reading on it? Silicon Valley Bank, we must be knowing a lot of our clients have their bank accounts with Silicon Valley Bank. And that's the most common bank for startups. So what actually went wrong with it? Why did the bank collapse? What happened?
People started
Withdrawing
the amount, and they didn't have enough funds to give it to the depositor.
Where did the funds go?
Hello.
They invested in the long term investment.
Okay, who was that? Anurag?
Yes, ma'am.
Okay, any I mean we need to understand fundamentally what happened.
They did not properly diversify the funds.
Yes, that's a very good point. Yes, that's right. But then where did they put it? That's not the reason. Let me just tell quickly. Silicon Valley Bank is like you all must be knowing. It's like all where in the news, 16th largest bank in US and 40th. I mean, like in terms of it's 40-year-old bank and all, and that's the most popular bank with venture capitalists, angel investors, startup industry, and all. That's the bank everybody wants to go for, especially the way they write it is like Silicon Valley, that is very very friendly with startups and all. It's all like obviously founded and like doing much more business in California because that's where Silicon Valley is. Millions of dollars we are talking about. When company gets funding, they were talking about 10, 15 million dollar, $50 million, even $100 million. All that money is put into the bank. So that bank is very, because it's supposed to be very startup friendly and all. The VCs also work with the bank. They give loan to VCs. The VCs in turn put money into startups. Startups will open up account with a Silicon Valley Bank. Again, the money goes in there. That's fine. They've been doing that for last, few decades. What suddenly went wrong? What went wrong is, again, we need to know what is the topic we are talking about. Interest rates. Interest rates kept rising in US. The Federal Reserve Board has been raising interest rates. What happens with that? When we have done, I mean, we should be knowing about all that. Whenever the interest rates go high, what happens to the bonds?
They
The value
invested proportional. They falls.
exactly. Oh yeah, Anurag, you must be knowing much
Hmm.
about this industry,
Yes, ma'am.
right? So they always fall. The yields fall. The value of the bonds fall. What did Silicon Valley Bank do? They, in fact, they just wanted to keep their money safe. But the point what Shweta made was correct, that they didn't diversify it properly. They did. Major chunk of their money went into federal bonds. Federal bond meaning government bonds. That is the safest place to keep the money. It's not like they were speculating around, or they were not in compliances, or they just gave loans left and right and all. What happens in India with few favorable big industrialist groups that we talk about, the loans are given to them and then they go and they abscond from the country, they just run away. Many cases that have happened in India. That was not the case. In fact, they put it in one of the most safest places, Federal Reserve bonds. But the Janet Yellen, if you know, who was the secretary, treasury and all, she started raising the interest rates in US. So obviously the yields went down, the value went down, by like almost 60-70%. So now if they want to go out and sell off the bonds to give money back to the people, they'll actually get a very low price. They'll get like 30-40% low price. That's a big, huge difference. And then when this news got out, that's how the valuation of their assets have gone down. Everybody started panicking. They all want to go up. I mean, and this is just one news go out, people start panicking like anything. They're like, everybody, millions of people will go and it's like, give us our money back. No bank can do it. None of the healthy bank can do this thing if everybody just runs at the same time and try to withdraw their money. None of the banks, howsoever healthy or good, nicely managed they are, they will not have so much of funds. So that's what happened. And I mean, that's just like, because it is all related to interest rate, because we're talking about interest rate topic, it just came in my mind. We should talk about that. You guys, I mean, all of us should, try to track these kind of news which are related to commerce and economics and industry and all. And especially Silicon Valley Bank was a big one because a lot of our clients have accounts there. We should be knowing properly what is happening. And the government clearly say we are not going to bail out any of those. We are done bailing out. 2008, it happened with Lehman Brothers. Now the biggest failure happened now after that with Silicon Valley Bank. So they clearly said we are not going to do anything with that. And that's when the FDIC came, and that it's a deposit insurance company and all that, everybody will get their money back and all. So the money, they will get it back. It's not as much panic as it was created, but obviously, like, if the money gets logged, you're not able to log into your account for even for 2 days, 3 days, the panic will happen. And here we are talking about startups, those who have to pay salaries to the employees, pay to the vendors. And if they're putting all their money only into one bank, obviously you can imagine what kind of situation they must be going through. That's how the entire banking market crashed, and now we know the credit suisse is having some other troubles. Then a lot of Charles Schwab rates, and I mean, all the banks, especially in US, if you see, they are like all-time low right now on NASDAQ. So we should be able to, follow a little bit and try to understand fundamentally what's happening there. So I think it's all fine now that people will get their money, but that's how, I mean, like, who could imagine that kind of situation, that Federal started raising the rates and that had such a huge impact. I don't think they ever, thought about this kind of situation. Otherwise, they would have taken some step. So it's not because of startups failing. Okay, that's the irony of it, that they thought that the money is very safe, and that's how it, like, the U-turn that it made. Okay, going back to our topic. So yes, we were looking into what are the points paid and all. Those are kind of, interest paid in advance, and those, most of them are deductible. We always have to get an escrow statement every time a client is buying or selling any property. Insurance premium, yes, we talked about that mortgage insurance premium are also deductible. Okay, these are all Schedule A deductions. Then I think we didn't go through charitable contribution, but we went through other itemized deductions, that there could be some more stuff that we can take on Schedule A only, which is line 16. If you go to that, there are certain other items mentioned. Okay, I don't think we did that. So what we should do is, okay, maybe this is a small topic. Let's just finish up this personal casualty losses. As the name suggests, these are personal losses, obviously, not related to business. Some kind of casualty happens, which is beyond the control. That's the whole meaning of casualty, is beyond the control of the person. Some, natural disaster has happened, or theft, fire, any accidents, and all those kind of losses to a non-business property. They were all deductible earlier. But they may deduct a limited amount, but they're deductible. So, but from year 2018 through 2025, we don't see a lot of personal casualty losses, because, again, this was one of the changes from TCJA, that until 2025, IRS has put a hold on it, or government has put a hold on it. Only for the regions which have been declared as disasters area, or federally declared disasters, only for those areas they can be allowed as a deduction. What is the latest area declared as a disaster right now, or natural disaster? Vandana? Hemant? What is it? Okay, anyone else? Yes, perfect. I thought everybody would jump on this question. That's just from yesterday. I just put it yesterday on the group. So there, what usually IRS will do is, like, none of the deadlines are applicable to them. There's a huge flood that has come in and all those things. No internet, or very bad, weak internet, electricity, blah blah blah. So they're being considered as a flood affected area, and even those March 15 deadlines, April 15th, are not going to be applicable to them. They get time until October 15th. And that was the news that I posted yesterday, if you had gone through it. Okay, so, but Yeah, even for federally declared disasters, only the loss has to be more than $500. Then only it is deductible. There has to be, now there are certain conditions and all, like the loss, if it was obviously, if it was covered by insurance and all, we cannot take that. So we have to see what is going to be the net loss. Okay, then only that is allowed. Minus any insurance reimbursements and all. Okay. So there's another rule that if the net amount of all personal casualty gains and losses after applying 500 limit is positive, there could also be gains. How can there be gains? There maybe they're selling off the property or something, or by selling that off, there could be some gains also being captured. So if it's above, if it's a gain number, if it's a positive number, they are treated as capital gain or losses. But if the amount is negative, they're all deductible as an itemized deduction on Schedule A. Okay. That's again, we don't see that very often, but we have to be careful about when we do 2023 taxes. Anyways, we have a lot of time for that, because a lot of our clients in Santa Clara County, and Santa Clara has been considered as a flood affected area. So we'll have to see what kind of loss we can take. Maybe some tree fell on somebody's roof, or some car got damaged because of the water, because of the flood waters and all. So next year we may see a lot of those kind of requests. Typically insurance should cover it, but a lot of times insurance doesn't. So we have to see what is the net loss after that, and if there are any gains associated with it, and then we have to take a call. And for 4684 is the form that we usually use for casualties. Even thefts are covered for the personal items. So, and then NOLs are typically associated with businesses and not individuals, but items such as personal casualty losses may create an individual NOL. Usually when we talk about NOL, net operating losses, we are always talking about business. How can an individual have a loss that is being carried forward? But this is one of the exception, that there could be a theft loss or personal casualty loss, which is not being able to, we are not able to take full deduction in certain year, so they'll be carried forward. Any question here? What they're doing is they're also giving some list that if you're insuring your property, probably you're paying insurance premium and all, we cannot take that as a deductible expense. Those are all non-deductible personal expense. Then second one is that if we have to get a professional appraiser to come and appraise the property for the purpose of insurance, that if there's damage to the property, what was the value of it before, after, and professional comes and they give that report. So whatever that cost is, do that. That's also not considered as a deduction. There's no deduction for that. Okay. Okay, Bhavani, can you read 5.17?
Yes. Personal casualty losses. In 2019, Marsha incurred damages to her home from a fire that was not federally declared a disaster. After insurance reimbursement, she had damage to her home in the amount of $10,000 and $3,000 gain on an antique that was destroyed. Marsha is able to offset the $3,000 gain with the $10,000 loss. The remaining loss is not deductible.
Yes, so what happens with the remaining loss? That's anyone else, like Garima, what happens with the losses then? If it's not deductible?
Ma'am, no deduction is available. We'll bear the losses. Is that so?
So there's nothing called carry forward losses?
Yes, ma'am. Is that so? I'm missing out.
Hmm?
Yes, ma'am.
Yeah, so those losses are carried forward. We saw that, right? The NOL can come even from a personal returns. They may create an individual net operating loss and all.
Yes, ma'am.
Okay. So what they're saying is 10,000 is the loss after the damage to our home, and all 33,000 is the gain. This is all after insurance reimbursement. That is net we are talking about. Okay, so that gain will get offset against the loss, but that 7,000 loss is not going to reduce any other income.
Yes, ma'am.
Okay? That's the max that they can do. So charitable contribution, again, this is a very standard deduction which probably every country will give. Again, this is a good kind of act. This is morally correct, ethically correct, that one, if they are earning money, they should probably do some charity, and all kind of, everybody is going to support that thing. So in order for the government also to support, how do they do that? In the form of giving tax benefits. So what they're saying is, yes, obviously, if you're doing charity, you will get some deductions. All that deductions will go on Schedule A, itemized deductions. And how much, now the question is that how much deduction can one get? What are considered to be charitable organization? What is qualified as a deduction? So this should not be misused. We know a lot of times, like these NGOs or so-called like charitable institutions have been made the hit, and the real agenda is something else in the name of that charity and stuff, and then some other things go on. And that's why there are all these conditions that have been put in, that what does the charity do, how money is spent out of that charity and all. Is that a publicly run charity? Is that a public charity? That means, is it run by government or is it a private charity? Depending on that, the deductions may be high or low. The donations can be made either of cash, or it can be made in kind, or it can be made in any property. Even providing, like running around doing some volunteering and all, even that is something which is considered to be charity. Even providing your time to go and volunteer, let's say teach in a school, or go to orphanage, go to old age home, or do some kind of those activities, that is also charity. Like some people can give money, some people can give time. That's also charity, but it's very difficult to put a value to somebody's personal time. So that's why we're not getting into that part. There's no deduction for that. It's very easy to find out what is the dollar equivalent if the money has been given to charity, or if certain item has been given, or some certain property has been given, because we have the valuers, the appraisers are there. We can get it easily valued. If somebody is donating a car, there are certain parameters on which the valuation can be done, and at least we get some estimates value. That can be considered as a deduction. But if somebody is donating their time, that's very, very subjective and all. So there's no deduction for that. But yes, if you're going and running around and spending your own money on gas and oil in your car or your bike and all, and doing all that work, there is a deduction for that. Because charity organizations may not reimburse for that. That's something they will expect volunteers to incur from their pocket. So obviously they have to be made to qualified organizations. They can be in the form of cash, property. All rights and interests should be transferred. We should not, some people, maybe they'll act very creative there, that okay, I'll give you this thing, but at the end, all rights are still with me. On the paper, yes, you can use this property, but I'm still the owner. I have a final say on it. That is not charity. Anytime you can withdraw it back. You cannot call that as a donation. Donation is something once given, you don't take it back. Right? So obviously all rights, interests, everything has to be done in a very in a very in a fundamentally way, that there are no hidden clauses over there, that rights or interests have not been transferred. The deduction is allowed in the year the contribution is paid. It maybe the charitable organization is receiving it in the following year, and they're probably putting it as a donation in the following year. But whenever the taxpayer has paid it, if they can prove it was paid before December 31st, they'll get a deduction for that. Generally, the fair market value of the property is seen. So, and this is very, very common. See, in US, every person has to have a car, because the public transportation is really bad there. It's not a luxury there. It's a necessity. We cannot roam around. The country is so huge and big, and the weather is so harsh, he cannot go on bikes all the time. So the person have to have car, and the cars get old and also what there's no it's better to just like, I mean, a lot of people donate car rather than scrapping them and all. That's very, very common donation. How do you find out? Maybe there is certain way of finding out what is going to be the fair market value and all. You take that. The deduction is limited to, they're giving some limits, they limited to 50% or 60% of AGI, adjusted gross income. That's a very big limit. Imagine somebody's AGI is $100,000. Any donation they do up to $50,000 will be deductible. So that's a very big limit. Usually people will not do. What do we usually see? $100,000 is the income. Maybe like really like generous people may do up to like $5,000, $10,000. Otherwise, people would just give $1,000, $2,000, and that's it. Like so, for practical purpose, everybody will get full 100% deductions because this limit is very, very high. Sometimes the limit is low, 30%, 20% in certain cases. That we'll see why. Okay, then there could be qualified organization, there could be public charity, there could be private foundations. Public is where that derives more than one third of its support from a member and general public, which is like church or temples. There's no restriction to anybody, like anyone, like they can all come there. Public will put in the money in hundi or some, donation box, and that's how the temples are run. So those are public charities. Private foundation is something different. Private foundation can be even a golf course can be a private foundation. Even a club can be a private foundation where there are only like 100, 200, 300 members, and they collect membership fee from each one of them. But the benefits are not given to general public. So only the members get that benefit. Okay, there could be a lot of religious, charitable, literary, scientific, kind of organizations that can be made. So let's just finish this example also. Obviously, this is again very, very general. What kind of receipt you should have in case IRS audits, something should be in writing. Obviously, it has to be from the organization. What is the amount paid? What is the name of the donor? Any tax ID and all, or date and amount. Date should also be mentioned. Okay, that receipt, having that receipt is very important, because if an individual gets audited and if IRS asks, how are you claiming $5,000 donation, at least something should be provided. Any donation of $250 or more definitely needs a written receipt from the organization. If you're going around and paying $200 to somebody, let's go to temple and say that, okay, $200 in the name of Balaji Livermore Temple. There is a temple actually with that name. So people go there a lot. So they said that, okay, Balaji Temple, $200. Fine. Even if you don't get the receipt, at least the check will show that you paid that money. But anything above that, you should definitely have a written receipt from the organization. The bank record alone is not sufficient. Okay, Sakshi, you can read 5.13 and then we'll close on it.
The local chamber of commerce hosts an annual food drive for needy children, a charitable cause. While dues and other donations to the chamber of commerce, uh, well, there's a volume button, ma'am, I cannot read.
But I took it
Commercial
now.
institutions, are not chamber of commerce are not charitable contributions, though they may be business expenses. Donations of food, cash, and other property to the food drive are considered charitable donations because the donations are exclusively for charitable purpose. These are deductible by the taxpayer as charitable contributions.
Right. See, what is Chamber of Commerce? Chamber of Commerce, I don't know what is the equivalent of it here in India, but they usually every city will have Chamber of Commerce. So it's like something related to municipal department and all. So that's one place where all the local business, small businesses, they can go, they can find out information, how to register the company, what to do, and all. So this is meant to give support to small businesses and all. And they will also tell about what are the compliances that they need to do and all. and they can become a member of that local chamber of commerce by paying some, say, $20-30 per year and all, and they will keep getting updates, small things here and there and all. Those, when you pay membership fee, we cannot take a deduction for that, because that's like a $20-30 will not be deducted. But a lot of times they do all these drives, like food drive and all, at the time of Thanksgiving, or some blanket drives when that gets closer to the winter season and all stuff. So if people go and donate, they'll get a donation receipt, and that's something that can be used for a charitable purpose. Even though both the money, both $20 or $30 is membership fee, and your donation, say, of $200 towards food, both of them are going to the same place, same chamber of commerce, same organization, but the purpose is different. So we have to see what is the purpose, okay, and then claim the donation. The other expense, membership fee, could be a business expense, not a donation, not a charitable expense. Okay, then we'll close it here. Any questions, anyone?